us to Let's Talk Real Estate, your weekly BS with Barry Saywitz about the current commercial real estate market here in Southern California as we take a no BS look at both sides of the issues driving the market today to find the best solutions forward with the man who seems to know, if he doesn't know the solutions, he knows the people that does. Barry Saywitz. Hey, Barry.
Hey, good morning, Paul. Thanks. We're back here again, and we're going to talk some more real estate. I'm Barry Saywitz, president of the Saywitz Company and Saywitz Properties, and in my 30-plus years in commercial real estate, I've been on all sides of the deal as a seller and a buyer, as a landlord and a tenant, as a broker and a principal, and I've learned to take a hard look at both sides to find the best real estate solutions in commercial real estate and try and navigate the ebbs and flows of the market. And so today is no different. We're gonna do it again, and let's talk real estate. Before we get going today, I want to do a shout out to my son Ryan, who has a very big AP psychology test this morning, and so he was up late studying. I was trying to help, but neurons and endorphins were enough to send me to therapy and trying to study them. So go get him, and good luck on the test. With us today is Stephen Gordon, who is the CEO and chairman of Genesis Bank and has a long history of banking and investment banking. And we're going to talk commercial real estate, we're going to talk banking, we're going to talk lending, and whatever other stuff we can make up. Stephen, welcome to the show.
Hey, thank you, Barry. Thanks for having me.
Yeah, so first I want to start, you've been in banking and as a result of that around commercial real estate for a long, long time. If we go back, your original sort of career, if you will, was in New York and Wall Street and investment banking, and then you forayed into the banking side of things. And in today's world, how is it different trying to come out of the COVID and dealing with all of that stuff versus beforehand?
Well, actually, it's extremely different. Everything has changed. The way one works, the way one goes about doing business, the way one communicates, it's all changed. And from the banking standpoint, nobody walks into a branch anymore. I don't know when somebody last walked into that brick and mortar. And even the elders have learned how to use technology and had no choice. Everybody's learned how to transfer, wire, pay bills, do all of their banking in a sense online or mobile. And what I thought was going to take 5 years to transition basically took overnight. And you never hear about anybody having to file for bankruptcy protection because they were unable to wire the money or pay the bills online or mobile during the last year and a half. Everybody functioned. So it's all changed. And the timing of launching Genesis Bank is, it really walked in with no legacy technology, no legacy platforms, no legacy physical infrastructure.
Yeah, and in your previous history, which is a long one, and I might add a very successful one, in building, founding, and developing Opus Bank and Fremont Investment Loan, and seeing those and building those to a very large organization. I guess one of my questions with Genesis Bank is why now, why this bank, and what's the plan for Genesis Bank?
But as you know, Opus Bank grew into being quite an institution here on the West Coast. We grew it from an idea on a piece of paper back on September 30th, 2010, when it was launched, and we grew it to being over $8 billion in total assets and 50 locations up and down the whole West Coast and 800 bankers. And the institution was coveted by a number of financial institutions out there, those who wanted to acquire the institution. And January of 2020, just before COVID, it was announced that the bank was being acquired by a different bank, by a larger bank that was publicly traded and overlapped in some of the same markets and wanted to be in some of the same markets that we were in and acquire complementary synergistic businesses. Then along came COVID. Let's call it the world shut down mid-March of 2020. And the acquisition of Opus actually closed on June 1st of 2020. That gap in between was a monumental moment. The world was shut down. Everyone was trying to figure out how to function within the economy, and no one knew exactly what this economy was going to be.
Right.
And
I'm guessing you were happy to head for the door at that point.
I was glad to be out. It seems like I've had this pattern over my career of I generally see when an economic cycle is going to hit, and then I sell the bank just prior to the cycle. And I can't say that that's what I saw here. No one saw COVID coming, and no one saw the impact that COVID was going to have economically, on the U.S. and world economy. But what I found happening was that I was hosting Zoom calls here in Orange County with 250 business owners at a time that were trying to figure out how to navigate their way through their own bank, or how to navigate their way through the SBA, or how to navigate their way through PPP.
Right.
And I remember getting off one Zoom call, and I kind of broke into tears because I was feeling like the pain and carnage that everybody was experiencing, that they were suffering through. And I recognized that was just a small microcosm of what must have been happening nationwide. So I was in between banks. I didn't have a bank where I could actually be impactful and make a difference at that moment. So I expedited a process with the regulators, the governmental regulators, both the state of California and the FDIC, to apply to start another bank. And as I said, that transaction, the acquisition of Opus, closed officially on June 1st. And on June 5th of 2020, so 4 days later, I filed the application with both the state of California and the FDIC, and that was approved by the state of California 5 months later, and 2 months after that by the FDIC, and that normally takes anywhere between 1.5 years and 2 years, and we went through the process very, very quickly. There was a need for that new bank to emerge with a clean balance sheet and the ability to truly be impactful.
Yeah, and so you took a long weekend, sold one bank, and started another one, it sounds like.
Well, there was a lot of thinking about it for about a year, and then I accelerated the whole process when the whole devastation hit.
Sure. And so when you talk about all these business owners and what they're struggling, I'm right there, right? I'm one of those guys, and then that struggle for the business owner certainly filters down to the struggle of its employees, just trying to keep things going and keep food on the table and try and navigate their own way through things. What are you hearing now from clients of the bank in terms of where they're headed, and is it, I'm guessing certain industries are really doing well and certain other industries are struggling with supply chain issues, and others are just still struggling in general with trying to get back on their feet?
Well, ironically, whenever something like in the case of COVID hits, or an economic cycle hits, what ends up happening is, while you just mentioned that the principal ends up going through a struggle and a day of analysis and figuring out like what does this all mean and how do I navigate going forward, banks end up doing the same thing. And you would think that you could turn to the bank and they'd be there to back you, support you on where you're going. Quite often when an economic cycle hits, the bank goes through a period of carnage analysis, if you want to call it.
Yeah.
At the same time, they got to figure out what their balance sheet now looks like. And in the same way that the client struggles, that ends up turning into a struggle for a bank. So they end up internally focused rather than going proactively to make a difference. What I'm seeing now that we've launched Genesis is that everybody is back to being very active. They're being very aggressive about their activities. They're being opportunistic, and the financial system is flush with cash. So here we are at record low interest rates, trickling around back and forth a little bit, and with potential upside direction in terms of rates. But we're in a unique, interesting economy. It's feeling like inflation is alive and well again, and people are, I think, trying to navigate rapidly into doing things before rates really kind of take off, especially in this real estate world.
Right. So if we sort of dovetail that, I think what I've seen, I'm curious your take, is we have now started to see people be able to be comfortable to make longer term commitments, whether that's in their own business planning or whether that's in lending or borrowing. And so now you do have people trying to take advantage for those that can make longer term decisions, and we've enacted that strategy in our own company's business plan. And so if I dovetail that into the commercial real estate market, what is your, not that anyone has the crystal ball, but what is your expectation in terms of where you think interest rates will be over the next 6 to 12 months? And how does that affect what happens in the commercial real estate market if banks do have money and are still willing to lend at aggressive rates?
All right, so I'm gonna bifurcate that for a second and take a step back and then forward, if I'm
Whichever way you want to step school.
okay. So you've got your traditional businesses, and then you've got real estate investors. And Southern California, as long as I've lived out here from New York, I've always been concerned about California being so real estate centric. And whenever a real estate bubble hits, a cycle hits, credit cycle hits, it takes down core business with it, and kind of sinks the Southern California economy, dragging it down with wherever real estate goes. And that's always been a little concerning. And I've always tried to make sure that I'm putting capital back into the system and enabling businesses, core businesses, to expand and grow. Let's just call them widget manufacturers.
Yeah.
And I'm seeing on that side that people are making investment, they're expanding, they're looking to be more aggressive about their activities, their business activities, as especially as coming out of COVID. Maybe we are, maybe we're not, but it feels like we're coming out of COVID, and they're not as nervous in their planning, right? So they're planning to move forward. On the real estate side, crystal ball, I grew up in a school of investment banking where my mentor in life always said, whenever he was asked about where interest rates are going to go, he'd say they're either going to go higher or lower or stay unchanged.
Yeah.
Right? So, but you got to be able to build a business that is resilient regardless of what interest rates do. You don't want to be totally dependent on interest rates. Right now, I think it's about liability management. So it's about managing that cost of funds, that funding cost, that the debt that one has on their real estate, and taking advantage of the fact that rates are so low. Well, let's use the example of lease rates, rent rates, keep on increasing, and that's creating inherent, latent equity or capital in those properties. So taking advantage of that. I do think now rates are going to work their way higher while the Fed is trying to get into a position of having full employment, a stronger, more resilient economy, and still being uncertain as to whether the economic or the increase in inflation that is appearing now, whether that is temporary or whether that's where we're really going.
Right.
And the question of that has to do with, we all know that during COVID, factories around the world were closed. I think that the auto dealership world is an interesting leading economic indicator. There's no supply.
Right.
You go and drive by an auto dealer and the lots are relatively empty, and there's a chip shortage, and that's impacting everything from appliances to God knows what. I mean, chips are in almost everything today. So getting supply, getting product, and pure supply demand, prices are going higher, right? But that's impacting everything across the board, from food to gasoline to shipping costs.
So if everything goes up, and real estate's really no different, right? You have prices for, I don't care whether it's industrial buildings or apartment buildings or even homes, they're at all-time highs. Then the question that people say is, should I go refinance? And I say, sure, just do it within reason and don't over leverage yourself. But then the flip side of it is, should I buy, or should I just wait and wait for the bubble and then see what happens? Which I'm not a big fan of, because who knows when the bubble comes.
Well, I'm also not a big fan of what real estate investors are starting to do, which is they're leaving their core markets that they're very familiar with, and they're going into markets that they're less familiar with, that may be cheaper markets. And those markets tend to be even more volatile, more cyclical. Like we've all seen, Phoenix periodically disappears.
Right.
We've all seen Vegas periodically goes out of business, and Texas periodically goes out of business as well. So apartment investors, as an example, I'm seeing significant apartment investors who own anywhere between 5,000 and 15,000 apartment units. Now all of a sudden, or not so suddenly, it's been going on for a while, looking into the Vegas market, looking into the Phoenix market, looking into Texas, and the core markets that they know, where they know every building, every street corner, every seller, every buyer, every broker. All of a sudden they're heading into other markets that they don't know quite the same way.
Yeah,
and that's always concerning when that happens.
And I think they do that because you're looking at a 2 or a 3 cap here in Orange County or Southern California, and you're looking at a reasonable return of 5 or 6 or 7% someplace else. and then you have to balance that, right?
Right.
And so,
But I feel like that's someplace else. You got to time right.
yeah, and then it's also a question of what is your MO and who are you and what are you buying? Because if you're the smaller to mid-size investor, are you buying for cash flow or are you buying for increased value?
Mm-hmm.
We've talked about it on other shows. Look, if you buy something today and you sit on it for 30 years, chances are it's going to go up and you're going to do well. It may go down and up in the interim, but eventually it should be worth more. If you rewind and look at Orange County 30 years ago, you bought stuff, you're a hero today.
Right.
So the issue then becomes, if you're just okay with a very nominal cash flow today, then you should stay here and buy some more stuff. If you really are cash flow oriented, then you need to go to other places because you're just not going to find it here. And the quality of the product that you're seeing today, unless you're building from the ground up, you're going to need to go in and fix it up. It's just you're buying somebody else's older property that they haven't taken care of and they're selling to you at the top of the market.
Well, you're bringing up a very interesting point, and I think it also has to do with the age demographic of that real estate investor.
Mm-hmm.
Somebody who's been doing it for many decades, who has seen many cycles and many boom bust events, probably is just going to stay it through and go through and they're probably a cash flow investor, right? And they're not about a short-term appreciation play. The younger generation, they've seen this concept that it works well when it does, which is the ability to turn the tenancy, increase the rents, and increase the value, and then pull out all the equity and go buy another property and sell it, right? So there's a huge amount of money chasing that strategy, and that's a very short-term play, a very short-term strategy, near-term returns, and I think that's wonderful as long as it works. And I know people that are backed by hundreds of millions or billions of dollars of partners' money, private equity money, and let's use the example of Texas. They're going to Texas and they're saying to the brokers, "Show me everything. I will buy everything." And their strategy is they're 2 to 3 years.
Yeah,
that's it.
And Texas looks cheap relative to California. So
everything looks cheap relative to California.
That is true.
Or coastal California.
And no different than you have people in LA buying stuff out in the Inland Empire or out in Palm Springs, and for them it's all a relative term.
Right.
And so the question I have for you is there a correlation? I mean, the stock market at an all-time high, really, and I don't have any answers as to where that one's going or figuring it out. You have the real estate at an all-time high and you have interest rates at an all-time low. Is there some dynamic that sort of shifts the mindset of people that, hey, it's just not going to go up forever? The market, the stock market, the real estate market, well, is there something that's looming or coming, whether it's from Washington, whether it's from Sacramento, or just a cycle in the market that you can see?
Well, I can say that every day that goes by, we're getting closer and closer to some sort of an economic cycle. Right? That's not profound. That's just like it's just a statement, right? Yeah. Every day we're heading towards that moment, and but I don't know when that moment is. We're in an unprecedented time where the government is pumping huge amounts of money back into the consumer, back into the the business environment, back into the economy, and that's only we would never do that in our personal lives.
Yeah.
Right? We would never run our personal lives where we are just debt on top of debt on top of debt, running a negative cash flow business. We would never do it, right? Right. But that's the way our U.S. government operates, and as long as there's someone out there to buy the bonds, treasury bonds, we're good. So all the economies around the world are keeping each other afloat. Right? So that creates at low while keeping interest rates near zero.
Right.
So that's a lot of gas on the fire. That's a lot of fuel, and I think there are people that are not necessarily qualified or skilled or experienced taking advantage of that. And so the money that went to the person who stayed at home and didn't go back to work, and that check that they got every month, but they didn't really need it necessarily. A lot of them did, but some didn't. And they run around, they're buying cryptocurrencies or whatever with that money, and it's crazy. But that's what's going on in this country. Money, the government is fueling the ability to really turn this thing on.
And I think you still have some of that going on, and the government continues to fuel it. Biden signed the bill the other day with the infrastructure bill.
Yeah.
So you're going to the good news is you'll put a bunch of people to work, and the good news is you'll get older roads and bridges fixed. But as you've said, you've just basically taken money you don't have and thrown it into the mix.
Right, and while still keeping interest rates at zero.
Right.
But there's a lot of uncertainty out there still. Is there another wave of COVID coming? Is there another something? Is something going to blow up? You just don't know. So interest rates staying this low, I get it, and no one wants to be the one pushing up interest rates in the face of something then turning in the economy at the same time.
So how do you think that plays into the banking industry as a whole? I mean, you have your own strategy and your own views, but I mean, there's larger banks out there that must be dealing with this and looking ahead and saying, where's our focus and what are we doing and how are we going to change our lending practices or geared towards what's going on?
Well, all right. So one, the client always does the exact opposite or wants to do the exact opposite of what the bank wants to do.
Yeah.
And I say that because like interest rates are at zero. So Barry, you want to extend out on the yield curve and you want to get the lowest rate you can get, right? You want to get, the lowest rate you can get fixed for the longest possible period of time.
No question.
And you probably also want a lot of interest only period, right? And then the bank wants floating, short term, amortizing. That's the preference on the other side of the table.
Right.
So the bank generally ends up having to give the client what the client really wants to get, or they're turning the business away because there's always somebody racing to the bottom.
Who's going to go chase it?
Exactly, and that's problematic, right? But you got to be disciplined in here because at some point or another you can't have it where only one side of the table wins. Right? It's got to be that partnership, and when we're backing a client, we're truly partnering with the client. The starting of Genesis at the time that we did was more than just simply about putting money into the system at a rate for a period of time. It was really about having an impact, making a difference, and I've done this a number of times, starting back in the early 2000s with Commercial Capital Bank, and then I was asked by the government and by Credit Suisse to come and clean up the problems that existed at Fremont General and Fremont Investment and Loan, and then launched Opus, and all of those were about building a bank, ripping apart a bank, restructuring a bank, turning it into a lot more than it could have been, and on its own, and acquiring institutions and taking them public, etc. But now, I really want to make a difference and have an impact in our economies. And if you think about it, Southern California, Orange County, LA County, Riverside, San Bernardino are anywhere between 60 and 75% minority population. And a lot of that population was left behind during COVID and during every economic cycle we've experienced. So here, what I'm trying to do is really partner with our communities and enable expansion and growth at the ground level and have an impact from a banking perspective, from a financial literacy perspective, from an educational perspective, from an idea generation perspective, and back those businesses and real estate investors and those with a passion for growing and expanding something, and bringing the full force of the firm to them, and we're, if you think about,
so you're putting the money back to the people that are in the trenches, basically, and making sure that the people that are out there and have the capital to be able to build their business.
Yeah.
So we just have 1 minute left. I guess what would be the one thing going forward into 2022 that you would at least suggest or recommend to our viewers and listeners to keep an eye on, that you think is really going to be a big thing going forward, that's going to help dictate what happens with the economy and ultimately back to the real estate market?
I think that this inflation thing is real. And if it does settle down, it's going to settle down at a higher level. If it's not like I really don't think we're going to go back to where we were, 2 years ago, pre-COVID, in terms of price levels, in terms of wherever we were in inflation or deflation. Right? We're going to continue with this supply-demand problem, and we're going to continue with valuation increase. And then things may settle down, but at that newly adjusted level.
Yeah.
And I think people got to get used to that. And I think people need to adjust their lifestyles to it potentially. and recognize that this is very real.
And it's not going away, and it's not going to solve itself in a day, and it's not going to solve itself by the president signing one piece of legislation.
No, especially because I think we've got a real problem going on right now from a leadership standpoint in this country.
Yeah, and I don't want to get political, although I think if we did, we probably have a lot more listeners. But as always, I enjoy talking with you and getting your perspective on a whole host of things. And so I do appreciate you coming on the show and sharing your opinions with us. It'll be interesting to see how things develop going forward, and wish you and Genesis Bank all the success. Thanks again for coming on.
Barry, thank you very much for having me. Always a pleasure to be with you.
Yeah, and so I want to also thank Sophia, our producer, Paul Roberts, and the whole team here at OC Talk Radio. And as always, we will be back again next week. We will talk more real estate. Thanks for listening in. I'm Barry Saywitz, president of the Saywitz Company, and we'll see you next week.